Question 1. A futures commission merchant, FCM, is required to file a daily segregation report with the CFTC detailing customer funds. What is the primary purpose of this requirement? A. To assess the FCM's daily trading volume and liquidity. B. To ensure that customer funds are held separately from the FCM's proprietary funds. C. To calculate the FCM's capital adequacy ratio based on customer deposits. D. To monitor the FCM's compliance with anti-money laundering regulations. Answer: B. To ensure that customer funds are held separately from the FCM's proprietary funds. The core purpose of daily segregation reports for futures commission merchants, FCMs, is to ensure the absolute separation of customer funds from the firm's own operating capital. This fundamental rule, often referred to as segregation, protects customer deposits in the event an FCM becomes insolvent, preventing their money from being used to pay the firm's debts. It reinforces that customer funds are not assets of the FCM, but rather held in trust for the customers. Always remember that protecting customer assets is a paramount concern for regulators. Question 2. A long hedger in the futures market would typically take which position to protect against a future increase in price? A. Sell futures contracts. B. Buy futures contracts. C. Buy put options on futures. D. Sell call options on futures. Answer: B. Buy futures contracts. A long hedger anticipates needing to buy a commodity in the future and fears a price increase. To protect against this risk, they would buy futures contracts today, effectively locking in a purchase price. If the spot price rises, the loss on the physical purchase is offset by a gain on the long futures position. This strategy hedges against rising input costs for businesses that will need to acquire raw materials later. The goal is to minimize price risk, not to profit from speculation. Question 3. Under NFA rules, which of the following is considered a guaranteed account? A. An account where a third party has guaranteed to pay the FCM any debit balances incurred by the customer. B. An account managed by a registered CTA with a guaranteed rate of return. C. An account where an introducing broker, IB, guarantees the performance of an FCM's customer trades. D. An account where the customer is guaranteed against any losses by the FCM. Answer: A. An account where a third party has guaranteed to pay the FCM any debit balances incurred by the customer. A guaranteed account under NFA rules specifically refers to an account where a third party, often an FCM or another introducing broker, assumes financial responsibility for any debit balances or losses incurred by the customer to the carrying FCM. This arrangement typically involves a written agreement where the guarantor promises to cover any shortfall, which provides an additional layer of security for the FCM extending credit. It's crucial to understand that this guarantee is about financial obligation, not about guaranteeing trading profits or preventing losses for the account holder. Question 4. Which of the following statements about price limits on futures contracts is most accurate? A. Price limits define the maximum amount a futures contract price can change in a single trading session relative to its opening price. B. Price limits prevent the futures price from falling below the previous day's settlement price. C. Price limits are set by the CFTC and cannot be altered by individual exchanges. D. Price limits are established by individual exchanges and specify the maximum permissible price fluctuation from the previous day's settlement price. Answer: D. Price limits are established by individual exchanges and specify the maximum permissible price fluctuation from the previous day's settlement price. Price limits are crucial tools used by exchanges to manage volatility in futures markets. They represent the maximum amount a futures contract price can move up or down from the previous trading day's settlement price during a single trading session. These limits are set by the individual exchanges themselves, not by the CFTC, and can be adjusted in response to market conditions. Understanding price limits helps in comprehending how trading halts and expanded limits might occur during periods of extreme price movements. Question 5. A customer opens a futures account and specifies that all trades must be executed only when the price of a certain contract reaches a specific level. This type of order is best described as A. Market order. B. Stop order. C. Limit order. D. Market if touched order. Answer: C. Limit order. A limit order specifies a maximum price to buy or a minimum price to sell, ensuring that the trade is executed only at the desired price or better. For instance, if a customer wants to buy a contract only when its price falls to $100, they would place a limit order to buy at $100. This provides price control but does not guarantee execution if the market never reaches the specified limit price. Always remember that limit orders prioritize price over execution speed. Question 6. A speculator believes that the price of corn futures will significantly increase due to adverse weather conditions. To capitalize on this belief with limited risk, they might consider A. Selling corn futures contracts. B. Buying call options on corn futures. C. Selling put options on corn futures. D. Engaging in a bear spread on corn futures. Answer: B. Buying call options on corn futures. To profit from an anticipated increase in price with limited risk, a speculator would buy a call option on corn futures. Buying a call option gives the holder the right, but not the obligation, to buy the underlying futures contract at a specific strike price before expiration. If the price of corn futures rises significantly, the call option's value increases, and the speculator can profit. The maximum loss for the option buyer is limited to the premium paid, making it a defined risk strategy for bullish speculation. Question 7. What is the primary difference between a first notice day and a last trading day for a physical commodity futures contract? A. First notice day is the first day an intent to deliver can be given, while last trading day is the final day for trading the contract. B. First notice day is the first day an offsetting trade can be made, while last trading day is the last day for physical delivery. C. First notice day is the final day to trade the contract, while last trading day is the first day for delivery. D. Both refer to the same day, marking the transition to the delivery period. Answer: A. First notice day is the first day an intent to deliver can be given, while last trading day is the final day for trading the contract. First notice day marks the initial day that the clearinghouse may notify a long position holder that they have been assigned a delivery from a short position holder. In contrast, the last trading day is simply the final day that a particular futures contract can be traded on the exchange before it expires. After the last trading day, any open positions must be settled either through physical delivery or cash settlement. It's vital to distinguish these dates to avoid unintended delivery obligations. Question 8. A managed futures account typically involves A. An individual managing their own futures portfolio without external advice. B. A professional commodity trading advisor, CTA, managing an account on behalf of a client. C. A futures commission merchant, FCM, providing discretionary trading services to its customers. D. An introducing broker, IB, making all trading decisions for a client without their consent. Answer: B. A professional commodity trading advisor, CTA, managing an account on behalf of a client. A managed futures account refers to an investment vehicle where a professional, known as a commodity trading advisor, CTA, makes trading decisions on behalf of clients in the futures, options, and foreign exchange markets. Clients grant discretionary trading authority to the CTA, who then executes trades according to their proprietary trading strategies. This setup allows investors to gain exposure to the alternative asset class of managed futures without directly managing their own trading. It's like having a professional portfolio manager specifically for commodities and derivatives. Question 9. Which of the following is most likely to be covered by the Commodity Exchange Act, CEA, and CFTC regulations? A. A stock option contract traded on the NYSE. B. A forward contract for the future delivery of lumber between two commercial entities. C. A futures contract for crude oil traded on an exchange. D. A bond future traded in the over-the-counter market. Answer: C. A futures contract for crude oil traded on an exchange. The Commodity Exchange Act, CEA, primarily regulates commodity futures and options on futures contracts traded on organized exchanges in the United States. A crude oil futures contract traded on an exchange clearly falls under this purview, as it is a standardized, exchange-traded derivative designed for broad participation and price discovery. While the CFTC has some oversight over certain OTC derivatives, its core regulatory framework is centered on exchange-traded futures and options. Remember that the CEA is the foundational law governing the futures industry. Question 10. A short spread in the futures market is generally initiated by an investor who believes the price difference between two related contracts will A. Widen. B. Narrow. C. Remain stable. D. Become inverted. Answer: B. Narrow. A short spread, also known as a sell spread, involves selling the more expensive contract and buying the less expensive contract within a related pair. The investor initiating a short spread expects the price difference, or spread, between these two contracts to narrow. For example, if you sell the nearby month and buy a deferred month, you're betting that the premium of the nearby contract over the deferred will decrease. This strategy aims to profit from a reduction in the price differential between the two contracts. Question 11. What is the primary role of an introducing broker, IB, in the futures market? A. To execute trades for customers and hold customer funds. B. To solicit and accept orders from customers, but not to accept customer funds. C. To act as a market maker and provide liquidity to the exchange. D. To clear trades for FCMs and provide regulatory oversight. Answer: B. To solicit and accept orders from customers, but not to accept customer funds. An introducing broker, IB, acts as an intermediary, soliciting and accepting orders from customers for futures and options on futures contracts. However, unlike a futures commission merchant, FCM, an IB does not accept money, securities, or property from customers to margin trades. Instead, they introduce these accounts to an FCM who then carries the account, holds the funds, and clears the trades. Think of an IB as the sales front and an FCM as the back office for customer accounts. Question 12. A customer submits a not held order to their broker. This designation means the broker A. Must execute the order immediately at the best available price. B. Is allowed discretion over the time and price of execution, but not the quantity or specific contract. C. Must hold the order until the market moves to a specific price level designated by the customer. D. Is prohibited from executing the order without further confirmation from the customer. Answer: B. Is allowed discretion over the time and price of execution, but not the quantity or specific contract. A not held order grants the broker discretion over the timing and price of the execution, allowing them to wait for what they believe is the best opportunity to fill the order. This is typically used for large orders where immediate execution might negatively impact the price. However, the broker does not have discretion over the quantity of the contract or the specific contract itself. The customer still defines the core parameters, while the broker decides the tactical execution. Question 13. Which type of order typically becomes a market order once a specified price is reached? A. Limit order. B. Stop order. C. Market if touched order. D. Good till cancelled order. Answer: B. Stop order. A stop order is designed to protect profits or limit losses. Once the market price reaches or passes the specified stop price, the order becomes a market order and is executed immediately at the best available price. For example, a stop-loss order to sell at a certain price converts to a market order if the price falls to or below that level. Remember, while a stop order guarantees execution once triggered, it does not guarantee a specific execution price. Question 14. What is the primary risk for the seller, writer, of a naked call option on a futures contract? A. The loss is limited to the premium received. B. The potential for unlimited loss if the futures price rises significantly. C. The risk of physical delivery of the underlying commodity. D. The futures price falling significantly, causing the call to expire worthless. Answer: B. The potential for unlimited loss if the futures price rises significantly. A naked call option is one where the seller, writer, does not own the underlying futures contract. If the price of the underlying futures contract rises significantly above the call strike price, the call option will be exercised, forcing the seller to acquire the futures contract at the high market price to fulfill their obligation. Since there's no theoretical limit to how high a futures price can go, the potential loss for a naked call writer is theoretically unlimited. This makes writing naked options a very high-risk strategy. Question 15. The National Futures Association, NFA, has the authority to A. Set federal interest rates. B. Audit financial institutions for compliance with banking laws. C. Enforce ethical standards and conduct disciplinary actions against its members. D. Approve initial public offerings, IPOs, of futures-related companies. Answer: C. Enforce ethical standards and conduct disciplinary actions against its members. The National Futures Association, NFA, is the self-regulatory organization for the U.S. futures industry, operating under the oversight of the Commodity Futures Trading Commission, CFTC. Its primary role includes developing and enforcing rules, conducting audits, and taking disciplinary actions against its members to ensure market integrity and protect investors. The NFA focuses on maintaining high ethical standards and preventing abusive sales practices within the futures industry. Think of the NFA as the industry's own watchdog. Question 16. A futures commission merchant, FCM, acting as a principal in a transaction with a customer must A. Obtain prior written consent from the customer before executing the trade. B. Disclose its principal capacity on the confirmation statement. C. Obtain express oral consent from the customer immediately prior to the trade. D. Only act as a principal in highly liquid markets. Answer: B. Disclose its principal capacity on the confirmation statement. When a futures commission merchant, FCM, acts as a principal in a transaction, meaning they are trading from their own proprietary account with a customer, they must clearly disclose this capacity on the confirmation statement provided to the customer. This disclosure ensures transparency and informs the customer that they are trading directly with the firm, not through a third-party market. While some rules might require consent in certain scenarios, the primary, universal requirement for a principal transaction is the disclosure on the confirmation. Question 17. The daily revaluation of a futures position to reflect gains and losses, often leading to margin calls or excess margin, is known as A. Settlement. B. Mark-to-market. C. Hedging. D. Liquidation. Answer: B. Mark-to-market. Mark-to-market is the crucial process in futures trading where open positions are revalued daily to reflect current market prices. This daily revaluation means that any gains or losses are credited to or debited from a customer's margin account at the end of each trading day. This practice ensures that margin accounts accurately reflect the true value of the positions and helps to prevent the accumulation of large, uncollateralized losses. This daily adjustment is why margin calls can occur frequently in volatile futures markets. Question 18. An investor purchasing a commodity pool interest is essentially investing in A. A publicly traded company that specializes in commodity production. B. A form of collective investment that combines funds from multiple investors to trade futures and options. C. A mutual fund that primarily invests in physical commodities. D. A type of hedge fund that only takes long positions in commodities. Answer: B. A form of collective investment that combines funds from multiple investors to trade futures and options. A commodity pool is a collective investment vehicle where funds from multiple investors are pooled together and then professionally managed to trade in futures, options on futures, and/or other commodity interests. Instead of individual investors directly trading, they buy shares or units in the pool, and a commodity pool operator, CPO, manages the trading activities. This provides a way for investors to gain exposure to commodity markets without managing individual futures accounts. Question 19. What is the primary characteristic of a basis risk in futures hedging? A. The risk that the price of the futures contract will not move in the same direction as the underlying cash commodity. B. The risk that the futures contract will expire before the physical commodity is ready for delivery. C. The risk that the relationship between the cash price and the futures price, the basis, will change unexpectedly. D. The risk that the hedge will be unprofitable due to high transaction costs. Answer: C. The risk that the relationship between the cash price and the futures price, the basis, will change unexpectedly. Basis risk is the most significant risk faced by hedgers. The basis is the difference between the cash, spot, price of a commodity and the price of its corresponding futures contract. While hedging aims to offset price movements, an unexpected change in this basis, i.e., the cash price and futures price do not move in perfect unison or the spread between them shifts, can lead to a less than perfect hedge, potentially resulting in a loss or gain on the overall position. Remember that the basis can strengthen or weaken, impacting the effectiveness of a hedge. Question 20. Which of the following is considered a discretionary account? A. An account where the customer must approve each trade before execution. B. An account where the broker is authorized to make trading decisions without specific customer approval for each trade. C. An account where the customer provides only verbal instructions for each trade. D. An account used by a commodity pool operator, CPO, to manage a commodity pool. Answer: B. An account where the broker is authorized to make trading decisions without specific customer approval for each trade. A discretionary account is one where a broker or commodity trading advisor, CTA, has been given written authorization by the client to make trading decisions, including the type of contract, quantity, and timing of trades, without needing specific client approval for each individual transaction. This grants the professional flexibility in managing the account, but it also places a significant responsibility on the professional to act in the client's best interest. Discretionary trading requires careful oversight and adherence to specific rules. Question 21. If a customer receives a margin call, they must deposit additional funds to bring their margin account back up to the A. Initial margin level. B. Maintenance margin level. C. Minimum account balance. D. Debit balance plus accrued interest. Answer: A. Initial margin level. When a customer receives a margin call, it means their equity in the account has fallen below the maintenance margin level. To satisfy the call and avoid liquidation, they must deposit enough additional funds to bring their account balance back up to the initial margin level, not just the maintenance margin level. This reset ensures adequate collateral is available for future price movements. Think of it as restoring the account to its fully collateralized starting point. Question 22. The term inverted market in futures trading refers to a situation where A. Futures prices for distant delivery months are higher than those for near delivery months. B. Futures prices for near delivery months are higher than those for distant delivery months. C. The cash price of a commodity is lower than its futures price. D. The price difference between two related futures contracts has widened significantly. Answer: B. Futures prices for near delivery months are higher than those for distant delivery months. An inverted market, or backwardation, occurs when the price of a futures contract for a nearby delivery month is higher than the price for a more distant delivery month. This unusual market structure often indicates strong current demand for the physical commodity, a perceived shortage, or a desire for immediate possession. Conversely, a normal market, contango, would see distant months trading at a premium to near months, reflecting storage costs and interest. Recognizing an inverted market helps interpret supply and demand dynamics. Question 23. A floor broker on an exchange is typically involved in A. Managing customer margin accounts and sending out confirmations. B. Executing trades for customers on the trading floor. C. Providing research and analysis to institutional clients. D. Regulating and enforcing exchange rules. Answer: B. Executing trades for customers on the trading floor. A floor broker's primary role is to execute futures and options on futures contracts for customers directly on the exchange's trading floor. They act as agents, seeking the best possible price for their clients' orders within the crowded and fast-paced trading pits or electronic terminals. While the role has evolved with the rise of electronic trading, the core function remains order execution. Think of them as the direct link between a customer's order and the market. Question 24. A customer wishes to open an account with an FCM but refuses to provide their social security number. Under NFA rules, the FCM should A. Open the account but place a restriction on withdrawals. B. Open the account but report the customer to the CFTC. C. Refuse to open the account. D. Obtain an alternative form of identification, such as a passport. Answer: C. Refuse to open the account. Under NFA and AML, anti-money laundering, regulations, a futures commission merchant, FCM, is required to obtain specific identifying information from customers, including a social security number or taxpayer identification number, to comply with Customer Identification Program, CIP, rules. Failing to provide this essential information means the FCM cannot adequately verify the customer's identity, making them unable to open the account. It's a non-negotiable requirement for regulatory compliance and preventing illicit activities. Question 25. Which of the following is the most direct benefit of a futures market for commercial producers of a commodity? A. Access to a diverse range of investment opportunities. B. The ability to speculate on price movements with leverage. C. Price discovery and the ability to hedge against adverse price changes. D. Reduced capital requirements for inventory holding. Answer: C. Price discovery and the ability to hedge against adverse price changes. For commercial producers, the futures market provides two critical benefits: price discovery and hedging. Price discovery occurs as transparent trading reveals a consensus on future prices, helping producers make informed decisions about planting, production, and sales. More importantly, futures allow producers to hedge, selling contracts to lock in a future selling price for their output, thereby protecting themselves from potential price declines before their crop or product is ready for market. This stability is invaluable for long-term business planning.